Oh, hey guys. Sorry, I just found out that you guys couldn't hear me. So thanks for letting me know. We'll start over. But good to see you guys. Hey, C Fazio, Lise, thank you for letting me know. Peter, James, Tim, Nestor, Wreck-It Ralph, Raj, great to see you guys. We'll start over. I'm sorry about that. I guess I thought I unmuted my mic, but I didn't. So basically, what I was saying is that this market ran up, obviously today, but we are starting to see a little bit of cracks, a few cracks inside of this market, and that makes me very hesitant. It doesn't makes me not really want to go long in this market right now. I could prove to be wrong, and this could just keep on moving higher, but I much rather enter on a pullback. If I'm wrong and the market moves higher and I'm not in any positions, my worst case is I don't make any money and I don't lose any money. But if I go into any positions and say this bull run is going to keep on going and I'm wrong and there's a pullback, then suddenly I'm sitting on some losses. So I'd rather be wrong in not entering the market right now, which is not an ideal entry anyways. Remember, there's only two really good times. There's only two proper times to enter a market. One is on a pullback and one is on a breakout. And we have neither of those things. We don't have a pullback. Obviously, this was a pullback. And then the breakout was really over here. Or really over here. And you could say maybe this was a pullback on Wednesday after the Fed meeting or after the Fed rate cut announcement. But it really just touched that EMA 8 for literally just a couple of minutes. So it's really hard to call that a proper pullback or a really good entry point. Very difficult for you to have entered at that point. But I guess if you really wanted to call it that, you could maybe say that was a breakout. But again, this is really more of the ideal entry point where we broke out above this. So on this day right here, we made a high here. It kind of consolidated sideways and then it broke out. So really the previous Wednesday was really the opportunity if you want to trade a breakout. Right now, this is trend and it's just moving. And so we just have to wait for that movement to stop because we don't have another breakout entry, right? Unless it consolidates definitively, then we don't have another breakout entry. So we do need a pullback or consolidation before we can get a nice, proper, high probability entry into the markets. So really, it's sort of a wait game. Just wait for the right opportunity. And for that reason, I'm just going to spend time answering your questions because I could show you, I could do a whole bunch of analysis, but what's the point if we're not going to get an entry? And I don't want to get you guys excited and be like, oh my God, let me go into this position when it's really not a great time. Even if we find a single stock that is pulling back or breaking out, and it does look like a good entry. For example, as people ask me about Tesla today, that is a breakout. It looks like a breakout entry, but we always have to take everything in context, right? Tesla is a major component of the S&P 500 and QQQ. It is highly influenced by the QQQ and the SPY, and it does highly influence the SPY and QQQ. So that means if the whole market decides it's going to pull back, unless there's very specific news on Tesla, it's going to get dragged down. If only because it's in a lot of ETFs and a lot of portfolios that do track the S&P 500. So if there's a sell-off in the SP 500 or SPY or QQQ or any other major ETF that Tesla is a part of, then as a natural balancing of their portfolios, they're going to sell a certain amount of Tesla. So it's going to make it very difficult for Tesla to independently go up when the market is going down. So for that reason, even if we have individual stocks that look like they're breaking out or they've already pulled back and might be bouncing, it's still not a good idea. We always look in context. That's why the first thing that we always look at is what's the SPY doing. And back earlier when we started the post-market review, we haven't done it too much lately, and we really should. But we look at all the major indices. We look at bonds. We would look at the dollar, right? We would look at commodities, right? And agriculture, and we would look at all these things, and we look at gold, and we look at all of these things in order to get that context. So right now, it's not a great entry point into the markets. So I'd rather spend time answering your questions, and I got a whole bunch of them over the weekend. So now is a great time to really start answering some of those questions. Let me see what you guys are seeing. Okay, good to book profit now or wait if your trades are near your profit targets. Yeah, great time to book profits. Yeah. Tesla PE is 300, crazy valuation. Well, PE ratios, if you're trading PE based on PE, then you're trading on fundamentals, and fundamentals don't matter in the short term. They will matter in the long term, but they don't matter in the short term at all. Right? No one goes, oh my God, it's the PE is way overvalued. And then we see the stock turn around. We could see it stay overvalued for an extended period of time, or even get even more overvalued before it pulls back. So it's not a great short-term trading tool. It's good for if you're investing and you want to take profits on long-term positions. Then yes, that would be an appropriate measure. We got to use the right tools for the right strategies or for the right purposes. And PE is not a trading tool; it is an investing tool. Hey Kay, good to see you. So let's take a quick look. Right now, SPY, we did say that it's already a little overdone, especially today. I was looking at CPC earlier today. Roger pointed this out to me. He's like, take a look at CPC. It's crazy. Well, I don't get a great view of. I'm down at 65. That was on Friday. I guess I don't have one for today. So TradingView is not the best for this, but 65 is crazy. There should be some sort of reversion. We did see in the pre-market, that's what I was saying when I was muted, that we did have that pullback in the futures, and pre-market we were low. Of course, towards the end of that pre-market session, as we were getting to session open, it did start getting bullish, and then we saw that run up all day long. It was a huge run upwards. That's pretty unusual. We don't get a lot of those, and I wouldn't count on getting multiples of those in a row. So for those reasons, I am very kind of leery that this is going to continue. So I'm just wait and see is the appropriate thing to do at the moment. So let me see if Thinkorswim will give me a more up-to-date CPC reading. Yeah, it looks like it will. So if we go over here and pull this up, okay, I'll just go to a daily chart. Okay, looks like we're at 0.82. Okay, so we're in more normal territory now, but it is probably going to start heading higher from here, because the normal rhythm is that we would move higher. Yes, we normally chop, and it's kind of meaningless. But right now, after that pullback so far out of range, it should be. This is not the right chart to look at CPC on. Let me get rid of some of these, and then let's move this to a line. Okay. So now that this today, according to Thinkorswim, this has popped up to about 0.82. So back in range, you see where I put my marks at 80 and 120. So anything beyond 80 is a little bit extreme, although we've repeatedly gone below it in the recent months. But you see it doesn't stay down there, it whips right back up. And let me see how well in recent months this has lined up with the SPY. So let's do that. Okay, so tiny bit of pullback right there. Didn't very mild pullback right there. Very mild pullback right there. And then here was a sharper pullback. This was obviously a much more extreme level, although this was pretty close. And then here, baby one, not immediately, but a little bit after. This one was a bigger one right here, associated with an immediate tiny little pullback. And here we went down and then went down even further. So we haven't really seen the pullback associated with this as yet. So I'm a little wary as well that we might see at the very least a little pullback from the SPY because of this extreme CPC movement on last Friday. Now, the other thing to remember is that the cards are still, well, at least today, the cards are still falling in place on the expiration of options. And Friday, we had a huge number of options expire. I think across futures and equities, commodities and everything all together, we had about 50 trillion, over 50 trillion in expiration. And what we saw before, immediately before, on the S&P 500 on the SPY is that on Thursday when I looked at it with, I don't know if you guys, I think it was on a different show. I think it was maybe Profit Panel. When I was looking at it, there was 50 billion in positive gamma exposure that day. And then on Friday, towards the end of the market, there was only 2 billion, which means that a huge amount of gamma got sucked out of the market and hadn't been replaced yet. And so by today, we should see that replaced and spread across wherever it's going to be moved. But look at that. It's still at only like 1.39 billion. So a huge amount of exposure got taken out of the market, at least positive exposure. So that means a lot of the money did not get rolled, or it did not get rolled into higher strikes. And something that we saw very different from before expiration is before expiration we had, I can't scroll. We had large gamma up here at 675, 680, 690, and 700. We had large amounts of calls up here, and we don't see that anymore. Which is really, because if you recall last week, well, maybe you don't recall last week because I don't know if I talked about it on the post-market review, but I was saying that, hey, if we get over these, maybe on options expiration, we could possibly run up to 700 into the end of the year because there was a lot of gamma exposure up here. But suddenly, after options expiration, that is gone. All that call ladder that we had up to 700 is now gone. And everything's concentrated right where we are right now. And then pretty tight range right here. We do have some negative exposure over here at 650. So that tells me that the market is no longer so sure. It's no longer so certain. And all that bullishness that was in the market suddenly isn't there. And it's not bearish. It's just not hyper bullish like it was before. And so we'll see. After a pullback, we'll see. It does seem like, and there are other factors too. There's momentum factors. There's sector factors. There's the number of stocks trading above and below the 50-day moving average to 200-day moving average, especially in QQQ. That is also pointing to some warning signs over here. And so right now for me, it's a time of caution. It's not a time to get hyper bullish. And so I'm just going to wait. I'm going to wait until the probabilities are in our favor again in order to enter the markets. Excuse me. So if I look over here in the QQQ, we are 49% below their 50-day moving average. That went up a little bit today, I guess. That was in the mid to lower 40s last week. Still, it's not giving a lot of confidence. If I go over here to QQQ and I look at that versus QQQ, obviously all-time high, but QQQE was the big problem last week. And you see it just kind of went sideways today. It didn't really push on to all-time highs. The high today matched the high of the day before and the high of the day before. Of course, we closed there today, and so, whereas we didn't the last couple times. But then it's just barely above this high right here. It's not significantly higher, unlike the QQQ, where you can obviously see a clear and obvious slope, where this high versus that high. You see that? Very obvious. So QQQE is not really participating yet, and that is also another reason to pause. If I look over here on the SPY, the way that we measure whether or not it has moved a little too far and we need a bit of a pullback is via the short-term moving averages. So if I see where we close right here, 666.84 versus where that EMA 8 is, 660.64, that is 6.2 away. So the ATR is at 4.9. Okay, so we're about 1.26 ATRs above the EMA 8. That's not a huge number. About 1.5 is where we start seeing it pull back normally, or it'll ride along up at that 1.5 and then pull back. So we're not at extreme in terms of the EMA 8, but if I look at the EMA 20, we just keep getting further and further away from it. So if I go 666.84 and I look at the EMA 8, that's 653.82. Okay, so we're 13.02 divided by 4.9. Okay, we are 2.65 ATRs above the EMA 20, and that is an extreme level. Normally, we'd expect maybe a 2 ATR. Another way I can see that is if I get rid of this and I go to a Keltner channel, that would make it a lot easier to see. So if I go to Keltner channels and I just do the standard 20 and 2, so that's EMA 20 and 2 ATRs, you can see that we traded up to that ATR and we've been riding above it for about 2 weeks now, a week and a half. And you just see that normal behavior. Goes above that 2 ATR for about a week, pulls back to the EMA 20. Traded at the 2 ATR for a couple of weeks, pulled back to the EMA 20. Traded above the ATR for about 2 weeks, very briefly pulled back to the EMA 20. Traded above the EMA 20 for another week or so, pulled back to the, well, actually technically below the EMA 20, but in the spirit of things, about the same. And then over here, traded to the ATR 20, up to ATR for about 4 days, for about 1 week, pulled back, traded up to the +2 ATR for a single day, and then pulled back. And now here we are at it again. 1, 2, 3, 4, 5, 6, 7, 8, 9. So almost 2 weeks now. So probably looking a little bit similar to this right here. And so a pullback to the EMA 20 is appropriate at this point in time and about the time frame that we would expect a pullback, because the longest we've seen in recent history is roughly that 2 weeks. Roughly that 2 weeks before we at the very least tag the EMA 20 intraday. Okay, but most of the time we pull all the way back and close near that EMA 20, not just tag it. So this was a little bit of unusual. This was a very long run. And just see, does it hold true? 1, 2, 3, 4, 5, 6, 7, 8. Did not immediately go back down to the EMA 20. This was a little bit different because it actually went to the bottom. This was a change of trend right here back in December. So it took a little longer, it just consolidated here and then it pulled back down. Okay, 1, 2, 3, about 1 week, pull back to the EMA 20. About 1 week, pull back to the EMA 20. Tag the +2 ATR, and it didn't pull all the way back, but it had trouble. And then before it moved to the EMA 20 again, and then pulled back to the EMA 20. Same thing here, roughly 2 weeks, pulled back beyond the EMA 20. Roughly 2 weeks, pulled back. About 1 week, or we could call this consolidation part of it also. So 2 weeks, pulled back. Same thing here, 1 week above, pulled back. Okay, over here, about 1 week at the 2, pulled back, 1 week, pulled back, another week, pulled back. So it's usually 1 to 2. This one's the unusual case right here. Okay, this one spent almost 1 or 1.5 months before it pulled back. So just depending on exactly where we are, the normal amount of time is 1 to 2 weeks. And we are roughly at the 2-week mark right here, or about 1.5 weeks right here. So again, for that reason, I'm expecting a bit of a pullback soon. And I could be wrong. And there are cases, unusual cases, where it does go do that for longer. This one right here, where it took longer for it to pull back to the EMA 20. But we go with probabilities, and we go with what the normal market behavior is. So again, I could be wrong, but I'd rather be wrong and miss opportunity than be wrong and lose a bunch of money. So that's how I'm operating in this current market environment. Let's see what you guys are saying. GIS upgraded SPX target to 7,500 for who's GIS? Will it work? Looks like they are an extremely bullish market. 7,500 is, I think, is extremely optimistic. 7,500 is yeah, that'd be hard. I'm not going to say it's impossible, but it'd be difficult. Right, 7,000 is more reasonable, but still, right now. So before last week, there was indications of it, and now all of that gamma exposure went away. It's going to be harder and harder because the market is building in more and more expectations. If we go to this Fed watch tool, and what are the catalysts that are going to do it? So October, we're basically priced in that we're going to get a rate cut in October. And so if we don't, then we can expect a tumble. If we do, then we can just expect mild bullishness upwards. And then for December, same thing. We've already built in 74% that we're going to get another rate cut. And so together with the previous rate cut, and now it's like basically 100% baked in that we'll get at least one. And so again, if the market is already anticipating and pricing in those rate cuts, what is going to be the major catalyst that sends the market upwards? The only sort of maybe thing that is still kind of unresolved in the market right now is tariffs. And I don't think the market cares too much about tariffs anymore because it's just dragged on way too long. There's already been a bunch of drama about it. It's being fought in the courts. We have one part of the government saying that he can't do it, and then we can. Maybe we have to give back the money and whatnot. It's too much. The market doesn't really care too much about that anymore until there is a solid decision. As long as there's uncertainty surrounding that, then the market isn't really going to care too much about that. So it's hard to see or say that there are enough catalysts, at least that we know about currently, that could send the market all the way up to 7,500. I think that's little too pie in the sky right now. But of course, that's just according to known factors right now. So if we say, hey, there might be a whole bunch of things that we don't know about between now and the end of the year that could, okay, fine, but we don't know about them, and I can't really price that in. So for now, based on the things that we know about that are floating around in the market, 7,000, yes, maybe. 7,500, I think, is way, way, way too optimistic. Goldman Sachs, gotcha. 800 points up in 90 days. 800 points up in 90 days. Yeah, that's right. So basically, what was the last 800 points? Why won't my ruler work? Okay. So I guess, I guess. So right now if we go from the beginning of the year till now, we are up 650. Okay. So it took us 9 months to get to 650. And so in less than 3 months, we're going to go another 800 is a little unlikely. Okay. Hey, Bubbly. Okay. So yeah, it's just too optimistic. Okay. So until I see a little bit of a pullback, I'm not really going to be interested in going long in the market. And I'm not interested at all in going short the market because it is very bullish. Okay. So this market is net bullish. So I definitely don't want to short anything right now. Okay. Let's see. How accurate are those forecasts of Fed rate cuts 1 and 4 months out? These aren't forecasts. These are according to futures contracts and bond prices. This is the expectation of actual positioning in the markets right now. Okay, so it's not actually forecast. So basically, if for example, it's the same thing with, for example, gamma exposure. If I see a huge number of contracts at 700, then what that means is there's a huge number of institutions that are expecting that the S&P 500 would be above 700, or SPY would be above 700 by wherever all those expirations are. Okay, and let's just say all the expirations were December. Okay, so if a large number of institutions are expecting that are buying calls at 700 in December, they're expecting that by December it's going to be above 700. Why above 700? Because if right now I want to buy a SPY 700 call at December expiration, okay, it's going to cost me $640. Okay, 6.4. Okay, so that means that in order for those calls to make money, then the market has to go to 706.4. Otherwise, I lose money because of the premium. So that means that if there was that huge number at 700, then that means, because the only way that on especially the SPY, there could be a huge number up there is if institutions were participating. Retail isn't going to make a huge exposure on SPY. So that would mean that lots of major institutions were expecting that the SPY can make it to at least 706.4 by December. Okay, so the same idea, except in the bond market, and very few retail traders participate in the bond market. So it's basically all institutional. So that would mean that based on where all of those contracts are expiring, both in the futures and in options and in actual bonds, that's how they get this. They calculate, oh, well, based on the number of bets at this particular percentage or this particular yield, and relative to all the other yields that are being placed, they have this giant probability equation. And they say that, okay, well, based on the positioning right now, then there's the market is expecting a 73.6% probability that will be down 50 basis points by December 10th. Okay, so that's how that's calculated. So it's not a forecast. It's actually institutions placing money bets. with 73.6% certainty that there's going to be 2 rate cuts by December. Okay. Yes, I did say that, Raj. We will get there. We will get there. Okay. So, like I said, today and probably most of this week, until we see the pullback, we're going to be more focused on some broad educational points and answering your guys' questions. And I got enough questions over the weekend to last us at least a week, maybe 2 or 3 weeks. There were a lot of questions. So the first one that I wanted to go over was one that I've been promising for a few sessions now that I would go over. I did answer the question, but I got the question repeated because I guess my answer was not clear enough or detailed enough to satisfy. So here we go. The first question that I'm going to answer today is why do the SPY and SPX performances not line up exactly and precisely? Okay, closed out on GSAT with a profit. Good for you. That's awesome. That's awesome. Great. But GSAT we talked about a couple of times over there. Great. So why would the SPX and SPY not perform exactly the same? And the number one answer that is going to be the root and the base of every single answer after that is simply that the SPX or the index, and every single index, is simply a mathematical equation. It is simply a calculation. Nobody can trade the SPX. It's untradeable. It's an index. There are no shares, there are no contracts, there's nothing on the SPX. It is merely a calculation. It is just the answer to a mathematical equation, and that's it. So basically, it's theoretical. It is just a calculation based on a bunch of other numbers. The SPY and anything else that is based on the SPX, like futures, for example, is an actual tradable instrument. And therefore, it is subject to things like supply and demand, market forces. And that supply and demand will push, absolutely, the price of the actual traded instrument beyond what a theoretical calculation will provide. Okay, so if demand is really strong, it'll push the price beyond upwards, and if supply is really strong, then it'll push it down. Okay, so for example, today in SPY, we are up 0.47%, and SPX we're up 0.44%. Pretty close, but not exact. And the very short-term reason, the intraday reason, is absolutely because of supply and demand. Okay. The other reasons why we get drift, if we're not just talking about intraday, then there are a few reasons why we get drift. And as a tradable instrument, SPY actually provides dividends. It collects dividends and it distributes dividends. And so the dividend distribution is going to distort the price movement, and reinvestment of dividend returns is also going to distort the SPY performance. So if we take SPY and we count dividend reinvestment, we should expect the SPY over a longer term to outperform simply just the index. Okay? But buffering that and preventing the SPY from just getting way out of hand above the performance of the calculation on the SPX is the fact that there's expenses. When you go into the SPY, there is a management fee. It's hidden to you because it gets automatically extracted from the price of the SPY. And that's the same with every ETF. There are management fees for ETFs, and therefore it's hidden to you. So if you just track their performance on that ETF, it is better than what the implied movement was. If you say the whatever ETF, IWM, QQQ, SPY, TAN, Solar Stocks, SMH, MAGS, it doesn't matter. If you take the 1 year performance and you said, I took all the components of it and I calculate how much they should have gone up, you say my ETF did not go up as much. Why? Because of management fees. They're hidden. So they get automatically taken out because of that. Okay. So those are the major reasons. There's a few more, but it's unimportant. It's unimportant. So really they track each other pretty well. There's not a huge difference if you're trading short term. And even if you're trading long term, or if you're saying, I'm going to buy and hold this thing for 10 or 20 or 30 years, it doesn't really matter anyways, because you can't trade the SPX. Okay. You can only trade the SPY. You can only trade futures. You can only trade the tradable instrument. So why it's different doesn't really matter, because you can only get this one anyways. So the exact reasons and every minute detail, don't worry yourself about that. It's not going to matter. Okay? What matters is the instrument that you can trade. Okay, so remember, SPX is just a calculation, and no one can ever trade it, but we can use it to kind of guide as a guideline of where we can expect the tradable instruments to go. All right. Okay. Yeah, we did have dividends on SPY recently. Yes, that is correct. Okay, so now that we've got that out of the way, hopefully that is a satisfactory answer. I did also get a couple of questions on, hey, how do I set up my intraday charts like yours? And how do I set up my daily charts like yours? And I wish I could just send you a link and say, copy my stuff. But TradingView has banned me from sharing my indicators and sharing my charts. So basically, they repeatedly tell me that all my stuff is unoriginal and not useful. So every time I try to publish something, they ban me for another 30 days or 60 days or whatever it is. So I can't directly share it with you, but I can show you how to set it up. So the SPY, SPX, anything that I'm looking at intraday is super easy. Before I show you exactly how I set this up though, I want to inform you, every time in the post-market show, I show you the intraday chart, I'm showing you the 1 minute chart because I like to see the exact minute something happened. So if I say, hey, the gamma exposure is showing that we're at 667 is about the limit that we might go today, I like to see to the minute where 667 was hit. Just like the other day, like the same minute that I sent out, hey, we're at the major gamma exposure, was the exact minute where it rejected from it and started trading down. So I like to see to a precise minute. However, if I'm trading, I might look on a 1 minute basis, but I trade on a no less than 5 minute basis. Okay, so I trade, and there might be specific instances where I might trade off of a 3 minute basis, but for the most part, I trade off of 5 minute basis or longer. So 5, 15, 30, 1 hour. Okay, just depends on how detailed I want to look, how much attention I'm paying to the trade, how short of a time I want to be in it. If I'm trading a 1 hour, then I'm probably going to be in it for 2 or 3 days. A 30 minute, I'm probably in it for 1 or 2 days. 15 minute, I'm probably only in it for today. And same with a 5 minute chart. Okay, so I will not make my trading decision on a 1 minute because it's not enough to confirm. So for example, this right here, if I say, hey, I think it's going to reject from the 2 sigma, right? The 2 standard deviation right here. Okay. And I trade that on the 1 minute chart, I'm going to be wrong. So if I look at the 730 bar on the 5 minute chart, where'd it go? So I look at the 730 bar on the 5 minute chart. Is that today? Nope, that's not today. 730 bar on the 5 minute chart. You see, I would not have made that trade to the downside because it didn't close on a red. It didn't actually reject that. It continued up for a while. And so if I wanted to trade that rejection of a 2 sigma, I would have done it on this bar right here at 8 o'clock. Wouldn't have gone too far, but at least it was better than trying to do that at 7:30. Okay, 1 minute is way too fine scale to make any trading decisions. Okay, so I just wanted to make that distinction because even though I'm always showing you 1 minute, I am not trading off of the 1 minute chart. Okay, so how do we set this up? It's very simple. You can see I only really have two indicators up here. Okay. Okay, so I'll start with, I'll just show you 5 minute because I don't want you guys to get confused. This is a clean chart, nothing on it except for volume. By default, there's volume. Okay, so to set this up, all I do is I go to indicators and I find some sort of VWAP. Okay, the one that I just happen to like the most on TradingView is the VWAP intraday. Okay, that's it. And that's all you have to do. Everything's on default. It automatically sets the 2 sigma by default. Okay, well, that's it. Super easy. Okay. The second thing I do is I add in the multiple MTF. Okay. And I set it up. The only thing I really care about is short term. Nope, that's the wrong one. Multiple MTF. I spelled that wrong. Multiple MTF. Multiple time frame moving average. There you go. The second one. So here I just set it up. I only care about 2 of them. So I'm going to unclick everything else. And the ones that I care about are the daily EMA 8 and EMA 20, because those are important levels that we often bounce off of. And I like to set them to the same colors that I use on my daily charts. So that's going to be blue and violet or red or purple, whatever you want to call them. Okay, so MA1, MA2, and I'm going to call MA1, I'm going to disable all the other moving averages. Although I may not have to because I already disabled the line, but in any case, it'll calculate faster if I disable all those. So I only want the first 2, and I want them to be on the daily chart. Oops, the daily chart. Okay, and I want it to be the EMA 8 and the EMA 20. Okay, EMA 8 and 20. And the colors, I guess I'll redo the colors over here just to make sure. Okay, and now I've got the EMA 8 right there. You see that we're quite a bit above it. No real threat of touching it tomorrow, most likely, unless we gap way down. And then even more so for the 20. And that's what I was saying on the daily chart. We're a little far away from both of those, but especially the EMA 20. The EMA 8 is not quite as an extreme level anymore because we did tag it on this day. Okay. And that's all I do for my intraday charts. That's it. No other indicators whatsoever. can we put gamma levels over these for non-directional days and do a trade? Yeah, so I'll show you that on a daily chart because it's a little bit more relevant unless you just do 0 DTE, which you could do. But the other question that I got, and this will probably end it for today, is how do I set up my daily charts? And this is my main daily chart, although I do these 3 down here also. So I'll show you how I set those up and how I use them, okay? So let's go ahead and put in a new clean chart over here. Great, okay. Okay, so we've got a new chart right here. So if you want it set up exactly like mine, then basically I come over here and I have a 4. So basically I have 1 screen on top, 3 at the bottom. So that's going to be this. Okay. And then over here, I don't want to sync up the time or the range or anything, because over here, this is going to be, for me, I set it up as a monthly chart. So I'm going to do this as a monthly. Okay. This one's a daily, this one's a daily, this one's a daily. On the monthly chart, what I care about is, first of all, I don't need the bars because it's, the candles on a monthly chart are not that meaningful. So I'll just change it to a line. And then I will do a simple moving average. Okay, simple moving average, and it's just going to be a 10 moving average, 10-month moving average. Okay, and this gives me a very general indicator if the market is bullish or bearish. So if I zoom in on this, okay, it tells me that we're bearish. We went a brief bearish in, what is that, March, okay, and then we went bullish again in May. So what does that correlate to over here? Why is this? These should all be daily. Okay. Okay, so over here in March. Okay, March, we went bearish. Okay, so if I do a horizontal right here, we can see that, yes, we went bearish. Why did I do a horizontal right there? Because if I do large trends, that was bullish. We crossed, and that was a change of trend, but the change of trend did not go immediately bearish. It actually went horizontal. Okay, it went in a channel like this. Okay, then we broke the channel right here, and so that then indicates bearish. Okay, so yes, we did go bearish in March. This break right here was March 5th or 6th. Okay, then we were bearish, and then here we crossed above it, and then we were bullish again. Okay, and we did not do the same consolidation upwards. At that time, we probably would have done it like this. We did not do that same sideways consolidation. We could call this brief period right here sideways consolidation maybe. And so you could call that upside up, or since now in hindsight, we can just call it one giant upward movement. Okay, but you could call it this. You could also call it this, with a very brief sideways movement right here, and then another breakout right here. Okay, you could do that also. But basically, that 1 month chart made it very easy for me to say, okay, we went bearish in March, bullish, and it went back bullish in May. Okay, and we are currently bullish. So that just a quick, easy way for me to see that without drawing all those lines and whatnot. Okay, over here, I like to have a series of Keltner channels around the EMA 20. So I'll just do Keltner channel. Okay, and I'll just do 3 of them. And what are the difference between the 3? Basically, I want to look at the 1 ATR. Okay, and I don't have a particular color. So 1 ATR, I don't know. I'll make it orange. Okay, then I will do a 2 ATR, just keep it the same, and then I'll do a 3 ATR. And why do I do this? Well, I showed you the power of the 2 ATR earlier. Okay. But if I add on that 3 ATR, then I know when we're really extreme. It's very rare that we'll actually go above the 3 ATR for any length of time. We saw that the 2 ATR could stay up there for 1 or 2 weeks, but the 3 ATR, if we manage to get up there, we're pulling back. Maybe not all the way back to the EMA 20, but we'll pull back to at least the 2 ATR. Okay, hit that 3 ATR, pull back to 1 ATR, and actually beyond. Okay, here we are getting pretty close to that 3 ATR. So that's another reason why we should expect that this can't really get that much higher without a little bit of a pullback. You see that 3 ATR pulls back, 3 ATR pulls back to the 1 or a 2 ATR, 3 ATR, pulls back down. Okay, so if we're in 2 ATR for any length of time and then we hit 3 ATR, I know that it is probably almost over, and we are getting there at this point in the market. We're not there yet, but we're close to it. And then the last one is just a measure of the medium-term trend. I use EMA here, and so these are we can just do 4. We don't have EMA, so EMA exponential moving average, and I'll put 2 of them. One will be set as the 50, and the other will be set as the 100. Okay. Yellow. I like yellow and green for these. You don't have to, and this gives me a medium-term trend. So as long as the green is above the yellow, then I'm in medium-term uptrend. So I've got a long-term and a medium-term. Okay, and this told me the same thing. Over here, when we crossed over, it was later than so I caught the bear on the 1 month over here on March 6th, but I didn't catch, if I'm going purely on a crossover, then I didn't catch that until March 21st on the medium term one. Okay, and then we didn't fully confirm the uptrend until the end of May on the medium term one. But this gives me a very nice, if I want a medium term trend, I can just buy right here and hold all the way to here. That's a pretty good trade, right? If you want a nice, simple, several month, actually this was over a year trade right there, that'll do it. And then you avoid this big downturn right here, and then you get in right here again. Okay, and then you get all of that. All right, same thing over here. If you're just looking for a couple of trades a year or one every year, medium-term trend right there. Sorry, right there. Okay. Okay, you would have made that. Okay, so those are the reasons why I have these different charts on my main screen. But for the most part, like when you see me talk to you guys, and 90+% of the time, my eyeballs are always up on this main screen. I just only occasionally, because I'm more of a short-term trader, I don't look at these a whole lot, except to kind of tell me, oh, if this starts to get close, or these two start to get closer together, then maybe I need to be careful because we might have a change of trend soon. And of course, this is a little bit more timely than these other two. And then on here, all I do is, for the most part, all I do is moving average. And this is probably going to take me a long time, so I don't want to. I'll go through it quickly. So 4 EMAs and 2 SMAs. EMA, moving average. Okay, and I'll just tell you guys instead of set it up, so you don't sit here watching me for the next 5-10 minutes setting this up. I use the MA 200, the MA 150 is just a placeholder for my eyeballs. I don't actually trade off of the 150. Then I use the MA 90. I did it backwards. 4 SMAs and 2 EMAs. I did this backwards. Sorry, guys. So simple moving averages are 200, 150, 90, and 50. And then the EMAs are 20 and 8. Okay. And then so basically after all of that, we've recreated my chart right here. Okay. And then I also add in the year-to-date VWAP and the quarter-to-date VWAP for quadruple witching. So technically this quadruple witching one should change to last Friday, but I'll do that after a week so that there's some data over here. There's not just 2 dots. Okay, so that's it. That's how my charts are set up. Like I said, over 90% of the time, my eyeballs are right here, and I just see in the short term, I'm looking at the 8 and the 20. On the medium term, I'm looking at that 50, maybe the 90. And on the longer term, I'm looking at the 50, 90, and 200. All right. What is your view on adding MACD, RSI, and Bollinger Band width? MACD, to me, is completely worthless and useless. I know people use MACD, but I mean, if I want to see the difference between 2 moving averages, I can just see it right here. And if they're getting smaller or closer, for example, this, I can see right here that they're getting closer and they might cross over. So MACD is pointless to me. And then especially the default settings that people use, like it's so random, like 26 and 9 or 8, or I don't even know what people use, but like why those values? It doesn't make any sense to me. And then RSI is not super helpful because it's really imprecise. So if you look at RSI, can stay overbought or oversold for really extended periods of time. So technicals are supposed to help you with timing. And if it just goes up there and stays up there forever, and you don't know exactly when to take action on that, then it's completely pointless. So I don't use RSIs. And then Bollinger Band width can be useful, but I don't really use Bollinger Bands. And therefore, Bollinger Band width isn't all that helpful to me. And institutions don't really use Bollinger Bands. All the tools that I use, that I care about the most, are institutional tools. Why? Because of my institutional background, but also because, number one, they're the ones who move money. And which means that these institutional tools are most useful on large cap stocks, maybe some medium cap stocks. Okay, so these are not exactly like, if I'm evaluating some random small cap stock, I'm not going to evaluate them the exact same way. The moving averages will still be relevant because retail traders use moving averages also because they've learned to use moving averages. But then other retail trader tools will become a lot more relevant on small cap stocks, but they'll be completely useless on large cap stocks. So for me, I just keep these on here because I can use them whether it's a large cap or small cap or whatever. But for the most part, I will focus on the large caps because that's where money is actually moving around. And gamma levels. Okay. If you have the gamma exposure trading tool, the trading terminal, okay, what's really cool is that you can export to TradingView. And it will generate this. You can copy the code. Now, it will not automatically update, so this is static. But if you just wanted to throw it on there now remember, I just did it on all expirations. So total gamma exposure. So if I do that, I can throw that on here. I can go to Pine Editor and open a new script. Okay. New indicator and paste that in. And this will be only good for SPY, SPY gamma levels. I'll add it to my chart. And oops, I added it to the wrong chart. I'll add it to this chart. Okay, and I'll get the major gamma levels right there. Okay, so I see that we have one right here at 670. That's the top one. It's a thicker green one. I have the second thickest one right here at 665, and I have one at 663. We busted through that 663 today, and actually we busted through the 665 today. And so I can positively expect that maybe we'll hit the 670. Maybe we'll pull back a little bit before we hit the 670. Maybe we'll pull back to 665, 673. And then bounce back up to the 670, but at least I have gamma levels here. If we're wrong about it, if this is too much of an extreme and we're right about the pullback, then I can expect that maybe over here at 655, which would be close to the EMA 20. But what gamma is telling us is that actually we might actually pull back even further than EMA 20 to that 650 right there. And if things get really bad, we might pull back to the 640. Okay. But remember, these are just static lines. So if you refresh your data, which you should refresh your data later on, maybe tomorrow or the day after, and then just delete this or just completely replace it and then redraw your lines. Okay, then you can get the gamma levels on your charts as well. Okay. The export is only good for the moment that you ran it. Okay, well, so I ran it on every expiration. So this isn't going to wildly change from day to day unless there's a major move in the markets. So I would refresh this every day. If I was going to throw these on my charts, on my daily charts, I would refresh them every day, maybe 2 or 3 times in a day. Okay, so you just hit refresh data, and then you export it again, and then replace the code on your chart. Okay. Okay. Hopefully that was insightful. Not only did you get to see how I set up my charts, but also why I have them set up that way and how I'm looking at the charts. So that is probably something I haven't really truly gone over. So hopefully you found that helpful. Okay. All right, guys. There are a whole bunch of other questions that people had asked me and I haven't gone through. So we'll keep on doing this all week, or at least until the market gives us an opportunity to enter or looks interesting. So again, hopefully you guys are learning a lot. I will see you guys tomorrow. So have a wonderful rest of your day. And we'll look forward to learning more together. All right. Okay. Bye, everyone. Have a great day.